Well, good afternoon, investors. Um, Hopefully the stock market doesn't have you too depressed today because it's another kind of rocky day in the stock market. But welcome to our April 26th edition of Bull Sessions, our theoretically truncated session because we do have a roundtable webcast tonight along with an extra session before that gets underway. So let's go ahead and get rolling here. My name is Mark Robertson. I am founder and managing partner of Manifestinvesting, and I'm joined here by Ken Kavula, one of the, well, again, our investing raconteur from mid-Michigan. Good afternoon, Ken.
Good afternoon, Mark.
And Kim's not going to be able to join us tonight, so she made an extra effort to be here this afternoon so she could say hello to everybody. Good afternoon, Kim. She may be up watching the ticker tape. Nope, she may have had to sneak away. That's fine. She'll check in when she gets back. All right, just a few themes for today. Again, we do have a session tonight with a St. Louis spirit flair to it. We're going to talk about the workhorses in the very center of the page. And those are the medium-sized companies that bolster our portfolio. We talked a little bit about them last week as flyover stocks because we tend to obsess on the small companies, and we hear an awful lot about the blue chip companies. So that's what we meant by flyover stocks, Ken. Welcome back, by the way, from your travels.
Thank you. Had a nice visit down in Virginia. Had a harrowing drive down, however. I never would have thought that I'd drive a full day in snow and measurable snow in the month of April. So
I know it. Well, we were there with you in spirit. We talked about you in your absence. All right, and then we are going to talk a little bit because I just need to vent just a tiny bit. But the Fed had one job, and that's the house on the second from the left. That image is in honor of getting one job. You have one job to do. And you have to look at it pretty closely to see what's wrong with it. But once you see it, you'll see that a person has done a nice job of installing a set of stairs and railings, but in the wrong place. I mean, I'm capable of doing this, as we were talking in the pre-session. Not fun. The Clydesdales are in honor of the workhorses. We'll be talking about them more tonight. And then the chimp is back. That is the Graham Stephan stock picking chimp. He's made it back into the top 10. So we'll spend just a brief moment with that, almost in the appendix this time around. And we have a couple of screens to take a look at, and they were screens that I used for tonight's roundtable session. The Twitter birds are on the page, possibly for the last time, and we'll probably bring them back one more time when Ken is right or wrong about whether this thing actually ever closes. So it's kind of interesting that thought is even out there, that deal could still fall apart, but it is still out there. All right. Here's our quick boilerplate legal beagle paperwork. No investment recommendation is intended. This is an educational demonstration. Everything that we do here is to illustrate and demonstrate some of the philosophies, methods, and techniques that are used by investors that follow the modern investment club movement. You'll be hearing our opinions as to how to interpret that stuff. Again, we look at it as 8 decades of investing success with a whole lot of lessons that can be learned and attempted to emulate. But we will be sharing some opinions about that. Please do your own analysis of any company that we mentioned here before making a decision. We'll try to remember to disclose if we actually hold shares. We do have our monthly roundtable tonight at 8:30 Eastern Time. We are going to start it at 7:30 Eastern Time with a session on celebrating our workhorses. And I'm quite pleased with how that turned out. I hope it worked out well for you too, also, Ken.
I'm very pleased with some of the points that we're going to make tonight, and a little bit taken aback when I sat down to actually put some statistics together. I guess I knew what they were, but I was a little bit amazed at how big some of the numbers were.
Yeah, I think sometimes those flyover stocks really escape our attention too much. We spend an awful lot of time, looking at the A's and the F's on our report card and missing the stuff in the middle. And sometimes that stuff's pretty good. So that's part of the deal tonight. If you want follow-up questions, or if you have follow-up questions, or if you would like copies of slides or whatever, our 2 email addresses are right there at the bottom of the page. All right, let's keep pressing on. We traditionally have included this one fairly often. I told you a couple months ago that the green bars would approach the blue line at some point. I had no idea whatsoever that it would be this quickly. And with the rate we're going right now, those green bars are actually going to drop below the blue line, possibly as soon as the next time we get together. So they do zig, they do zag, and they do come back to that line. So nobody should be surprised by that. There probably are a few more bargains. You can see that return forecast has returned to average or slightly above average levels. What I'm talking about are the red dots. The red dots being the collective or aggregate return forecast of the companies that are in the value line standard edition. And that is back to approaching 12%, which again is suggestive that there might be some opportunities to accumulate a few stocks. Even though I think, Ken, we're probably back in one of those moments where you got to grit your teeth a little bit. That would be my guess.
Well, it's even though I know that inflation's eating away at my dollar bills that are sitting in my portfolio, it's a kind of a scary thing to commit some of those dollar bills to stocks right now, Mark. I'm taking my time and doing a lot of due diligence before I commit those dollars to the stock market right now, at least.
Well, I don't know if Kim is still with us. If you're out there, Kim, when we first came on, she was doing a bit of a primal scream and threatening to shut off her TV for 5 years.
Yeah, I'm still here, and yeah, I know this is all part of the market, and I'm like, daggone. I was really proud of my gains, but they've been eating away.
Well, it's interesting for those folks that have never been through a real protracted one of these, but my hide's gotten considerably thicker since 1987 when I encountered my first one, and I can't ever say that I get used to them, but at least I understand what the feelings are, and I can remind myself that I've had those feelings before, and that if you just stay calm and stay steady and stay disciplined, you'll come out the other end of it without that much pain, I guess is a good word. It doesn't mean you won't lose some money. You will. People are losing money right now, but that's the opposite kind of side of the coin of the last 2 or 3 years, where people were making an awful lot of money in the stock market.
Yeah, and for those of you who, and actually there's quite a bit of experience in the room as I look down that list of names, but I mean, I think it was actually more painful that long drawn out period here that basically lasted over like 2 years following Halloween 2007. This one back here, though, the white areas is what I'm talking about. The white areas underneath the blue line. That one was sudden, and I actually hated the way it bounced back so quickly, because I was in the middle of acting and making hot dogs. You guys all know that story. But what I would encourage everybody to do is go back and look at the stocks that we were talking about at the end of 2008, early 2009, see what happened to them. You don't even have to go back that far. If you go back to March 2020, April 2020, and you actually look at some of the stocks that were being kicked around, we're going to talk about that a little bit. The stocks that we picked during that first COVID cancellation conference, my goodness. You go back and look at some of that stuff like Ann suggested we look at last week. Those numbers were phenomenal. And that's fun.
Joe's asking an interesting question, Mark. For a lot of years, the last 8 or 10 years, we've been dealing with this TINA. There is no alternative to stocks. And Joe wants to know if either one of us see any alternatives on the horizon right now. And I've listened to people on television tell me that bonds are becoming attractive, and I just can't agree with that at the moment, at least. I don't think bonds are attractive at all right now. And Joe, I'm still of the camp where I'm just going to continue to invest regularly, invest prudently, and stay disciplined, and try to stay on top of what I already own, and not get overly confident about any of the stocks that are in my portfolios. Be willing to sell if I need to, and be willing to add to them if I think that the company is ultimately a good buy. I like the point that was made on one of the programs this morning that I was listening to, where an analyst that I'm very fond of made the point that some of these extreme buy downs in some of these stocks is going to push companies that have a lot of cash into doing some extreme buybacks. And so earnings might continue to rise, even if sales tail off just a little bit. Now, it's engineering. I'm not a big fan of financial engineering, but at the same time, if a company is smart enough to buy back its stock when it feels it's significantly undervalued, that's the kind of company that I want to take a serious look at.
Yeah.
And join in with the crowd, with the crowd of insiders. Now, that's the only time a lot of those guys get a chance to really buy back in any kind of quantity, isn't it, Mark?
Yeah, and well, I mean, we can show many examples where they bought back stock when they shouldn't have also.
Oh, absolutely, yeah.
But yeah, I agree. If they're doing it under the right conditions, that is actually a powerful attribute of good capital management. You know, the only other thing that comes to mind for me is Matt Spielman has been talking about the inflation adjusted bonds that are out there. And for a certain part of the portfolio or a place to hide in for cash, maybe we set up with Matt to come in and talk for a few minutes about those, because he's actually written fairly extensively on it. So Matt, if you're interested in doing that, maybe we could spend a little bit of time talking about, you know, what are the restrictions and what can you actually do with them. And
you're talking about tips, right, Mark?
Yeah, tips.
Okay, yeah.
I think that might be you know, one of the answers to Joe's Tina question.
Yeah, it's a mathematical formula that for folks that aren't really comfortable with numbers can kind of make your head spin a little bit. But you're right, there is a little bit of attractiveness to something like a tip at the moment. Yeah.
Some of those numbers are actually getting fairly large. All right, let's go ahead and do a little bit of we've looked at this. So I just want to take a quick check-in on it. We've presented this a few times now. The thing that we find fascinating is that the mid cap, the orange, represents the S&P 600 mid cap, or excuse me, the S&P 400 medium-sized companies, mid cap companies. The blue is the S&P 500, and the red is the S&P 600 small cap companies. And we just find it a little bit fascinating that the theoretically medium-sized companies are leading this by a fairly significant amount. And again, going back nearly 30 years on some of those statistics down at the bottom, I just think it's really cool to grasp the fact that a few percentage points make such a big difference in that last column over here on the right. And that's why we, with white knuckles, try to extract a percentage point or two or three, and why we aim for 15% over the long term, because of the difference from top to bottom there is actually pretty massive.
Mark, I'm going to correct something I just said before it gets much more into the program. Matt has corrected me. He's talking about I bonds, not tips.
I'm sorry.
And there is a slight variation between the two, and he says we can talk about tips as well, but Nick jumps in and says he thinks the basic difference between the I bonds and the tips is that you can lose some of your principal with a tip. There's no loss of principal with an I bond. So yeah, and Matt says he'd be glad to jump in sometime on a Tuesday and talk about those things with us. Okay.
I'll coordinate that with you, Matt. That sounds like a good deal.
I wanted to make a comment on this chart also, Mark, where we're kind of stuck with what the market does. So we're stuck with this idea of capitalization as a way to measure the size of companies. And I wanted to stay kind of clear in folks' mind that when we're talking about small companies, we're talking about faster growing companies, and that doesn't always sync really one-on-one with the idea of small cap. And the same thing's true about mid cap versus medium-sized companies. We're talking about companies that grow their sales now in the 7 to 12% range, and that doesn't always jive with a mid-cap company as well. I think if you come to our session this evening, you're going to be surprised at a few of the companies that we would actually classify as mid-size, where I think the general investing public would see them differently.
No, I agree completely. You know, when you throw it into a mid-cap characterization, you know, throw it into that box, keep in mind that the companies that are in that listing of 400 companies include some distressed merchandise that are only mid-caps because they're struggling. And and I may figure out a way to do this in a meaningful way. If you subtract out and actually isolate by growth rate and isolate by quality, you probably can make a chart that would be even, you know, way off the chart dramatic. You know, the same type of chart, performance over time. And the hint that that is true is right there staring right at us at the top. That's why I added it to the slide. The value line arithmetic average is 1,700 companies equally weighted. And look where they end up. They're theoretically a combination of the things down below, right? And so that's
but
basically...
it's a choice group of companies, though, Mark.
It is. It is. It
Yeah.
includes all of those that are at the bottom in addition to another couple hundred companies. But yeah, I think that could be an interesting exercise. I'll put that on my list of things to do. All right, let's talk a little bit about the stuff that's going on with the Fed and all that kind of stuff. But Michael Burry's been in the news here lately. He cancels his social media accounts and comes back, and he's done that a number of times. But a couple of years ago, he began to argue fairly extensively that index funds were a vulnerability. That and the reason being, the companies with the largest capitalization, the Apples and the Microsofts and all that, actually are the ones that receive the most funds. As the money flows in, they actually receive the largest investments, whether they deserve it or not. And he sees that as a problem. So basically put together this chart just to put the long-term perspective on the S&P 500 into context. And the reason that I point to this is, again, I think that the interest rate stuff has really been not handled very well, and I'm sugarcoating. Is that better, Ken?
I think that's a nice way of putting it, Mark. Okay.
Could it suboptimal? Well, let's call it suboptimal. And there's actually a pretty good article by the St. Louis Fed down there at the bottom that talks about, you know, what has been done. As recently as just a few months ago, they basically promised to keep it near zero through 2023. And they've obviously gone back on that. And I don't think necessarily that was the right thing to do, but they basically were broadcasting that, which makes what they're currently doing a tremendous surprise and a shock to the market. So
in a relatively short amount of time, Mark.
Yeah, and they basically now appear to be kind of in an overreaction, almost a panicky mode, which is not doing any of us a favor at all. And the other reason I bring this up is that we've talked about the lost decade before. I call it the Accampora decade. Ralph Accampora came to Detroit back for our 50th anniversary convention back in October 2001, after all the stuff had happened in New York. And again, I've talked about this many times, so I'm not going to go into great detail, other than he basically said that anybody who blindly invested in an S&P 500 index fund at that time was going to get killed over the next 10 years or so. And was he ever spot on? And the reason he said that is it had been such a hot period going into that time frame for the S&P 500. It basically took 10 years for that to wear off. And then you can see on the right half of this chart how hot the S&P 500 has been for the last 10 years. And I guess I'm just posing the question, are we not vulnerable to the same type of thing again if we aren't careful? And again, we don't invest in markets. I get that. Oh, excuse me. We don't invest in markets. We invest in stocks. So that's always something to keep in mind. But I do think there is some vulnerability there. And that
Well,
is,
some of that vulnerability, I think Mark might be playing out now.
then yeah, we might be in the start of that right now. And that is Henry VIII, his English Mastiff. It's not a bull
Have
mastiff.
you seen or heard any more from Ralph lately?
Not real currently. How about you, Ken?
No.
No, he's been kind of quiet the last year or so. At one
I used to
time,
see him
he
on
was.
Twitter saying stuff, but I haven't seen him there either.
I don't remember if he's possibly part of the Dallas convention or not.
Well, and Mark, I think that your idea about, or what you're presenting on this slide, dovetails real nicely with one of my pet peeves, and that's that the relative median age of our financial analysts that appear constantly on the networks has to be in their mid to late 30s, maybe early 40s, with a pretty hefty sprinkling of people in their early 30s. And those folks have never really experienced, from an investing point of view, a long-term slowdown, inflation in any way, shape, or form, high interest rates in any shape or form. And if the investor that's been around for 25 years is pausing and feeling that queasy feeling in the pit of their stomach, I'm just asking myself, what must some of these analysts or these commentators be feeling going through something they've never, ever experienced before, and trying to explain it to a group of people that are at best a little bit queasy about what's going on, period. It bothers me a great deal that we don't listen to what's happened before and bring some of our wiser heads in to occasionally remind people that we have gone through some of these things and we will make it and we will be able to go through them again. I appreciate the Josh Browns of the world rather than some of the more flamboyant analysts that seem to be saying almost anything just to be able to get some airtime on the television.
Yeah, and following the lead of whoever be sitting in the chair across from them too.
Yes.
Yeah. All right, so here's some fun, and here's some of the debate. We don't need to go into this in any great detail. I just pulled this down to pick on index funds a little bit because I think they are a vulnerability at times. Ben Carlson is also in the camp of can some of them be thought of as momentum strategies? I would actually think of, in some cases, the S&P 500 could actually become a performance chaser at some point, and that's kind of what led up to that 10-year period. A little bit of performance chasing, and yeah, it's possible. So, one of the things that we have that's actually pretty passive, pretty close to very, very passive, is this Bare Naked Million. It's that answer to that question that we received around Christmas time, 2005. What would you do with $1 million? And this is what we did with it. And I think we're up to 10 transactions all time in the fund, going all the way back to that point in time. And the flagship or the anchor is the Vanguard Growth Fund. which actually dovetails with what you were talking about a few minutes ago, Ken. That is a selected number of growth companies. You know, it's not just a smattering of the S&P 500. It's actually a fairly decent growth company, as evidenced by this 12.1. It's a good fund. And
Mark, can you identify TMFS for us?
that is the Motley Fool small cap fund.
Okay.
And we're in the middle of changing that over, hopefully next week. They invest like we do too, so some of the stuff in there. But you know, the participation in this bare naked million is if a company does become a candidate for sale, we try to replace it with somebody who is a leader in their industry, with obviously high quality and on sale, or with an attractive return forecast. So that's our passive funds. Here's that article that I would point you to if you want to dig into it a little bit deeper. You know, are some of these index funds vulnerable to this performance chasing? I think it's possible. It's something to be aware of, something to think at. And this is Carlson's column. In the middle of that column, though, there's this chart, which I find absolutely amazing. Really scratching my head over this one. When you take a look at long-term returns from stocks, and you find out that you have such a concentration of exceptional performance in a fairly small group, along with some catastrophic performance on the left. This one really, really tweaks a nerve for me in terms of, you know, why would you invest in that thing on the screen when we have methods and techniques that are 8 decades in the making that concentrate on the yellow bar? I guess that's what I'm asking. Is that too much of a stretch? Is that a lack of humility? I don't know.
Well, in nursing, Mark, we would say that the bar on the right is showing evidence-based practice that our methodology works. So don't be biased in thinking that because we're not professional people, we don't know what the heck we're talking about. The numbers tell us we do know.
Yeah. So, I mean, we spend a lot of time in that yellow bar is basically my point. And we'll show you a little bit more what we mean by that here in a minute. I'm just wondering if this isn't another rule of 5 where you really are out there. It's really kind of a fascinating notion that if you've got 5 stocks chosen basically at random and you put them through our study techniques and processes that are historically time-honored, you know, is it something like 20% of them that would survive that type of a test? I think that's generally what we see when we're out there shopping for companies, Ken.
Well, I'm not sure that this is a rule of 5, but at the same time, it's a different rule. It's not the rule of 5. It's a different rule of 5 that
I'm putting air
yeah. I think that the original rule of 5 just points to the difficulty of picking 5 companies and being right all the time. And that's the key, isn't it? When you're trying to pick companies in that yellow box, the rule of 5 says maybe you're only going to be able to pick 3 out of 5 or 4 out of 5 companies in that yellow box that outperform, and occasionally one that you think belongs in the yellow box doesn't actually belong in the yellow box.
Exactly. Or something goes wrong. Yeah, our rule of 5 is precisely that.
Yeah.
If we build expectations for 5 of the stocks that are in here, that are in this universe, the chances are one of them is one of them.
Yep.
So that leads us into this. This is the Manifest Investing 40. It's the 40 most widely followed companies at Manifest Investing. And if the companies in this yellow area are basically companies that have a long-term return of 6% or greater, I would just, and again, I'm just suggesting that it's really kind of cool that we can find a level of protection and an opportunity. There are no guarantees in this business. Everybody out there knows that. The process works. Look at these numbers. As you go up and down this column, again, these are the 40 most widely followed companies. Some of these are brand new, so ignore some of these lower numbers down here. But look at the frequency that those numbers are above 6. And I find, frankly, great comfort in that. So that's kind of my soapbox moment for today. It's really kind of cool. Look at the numbers up at the very top of the chart. I guarantee you those top 10 are very widely held by people in our community. And this is what
I'm
Ken
looking.
usually
I'm
jump in
looking
and say, how many
carefully
was
at
your
the
own,
top.
Ken?
Yeah, I'm looking carefully at the top 25 mark, and the 4 or 5 exceptions that are under 6 in the top 25. I can think of really good reasons for every one of those to be exceptions to the rule, and why I would not place them as high as they're being placed by the folks that buy stocks in the or that put stocks on the uh, dashboards in Manifest.
Mm-hmm.
I'm noticing GE's in there yet, and GE is, from my mind, GE's a legacy holding in a lot of portfolios that people had just gotten tired of playing around with and just let it sit. Maybe
Exactly.
that's too pessimistic, but that's where I see it.
Well, that's why it's still in mine.
That's why it's still in mine too.
I have not sent it packing yet, and I will be making that decision here fairly soon. Especially since Kim says we're supposed to have some cash to go shopping.
Well, I sold my GE all the way down to my dad's original number of shares, and that's what I kept. So it's such a small piece of my portfolio today that I can afford to let it do almost anything it wants to do.
All right, so I'll dismount the soapbox a little bit, but I just find that I just think it's cool. I could probably talk for hours in great detail with case studies on a lot of this stuff. It's just fun.
I think it's more interesting, Mark, to look at the bottom 10 or 12 and to come up with names that are at that 6 plus and say to yourself, wow, I didn't realize, I mean, I'm especially looking at Danaher. I'm looking at T. Rowe Price. I've always known they're good, solid, high quality companies. Gentex and Oracle as well, and I didn't realize that. It's very interesting, very interesting. That's as far as I guess I'll go.
Yeah, the numbers we're going to see more from our workhorses tonight. That the numbers can be absolutely astounding. Now, the other thing to point out about this type of list is it is so biased towards the large cap, large companies. And you see that here with the sales growth rate of 7.8. I mean, I'm not, I don't shed a tear when a company with an extremely low growth rate leaves this list. Just leave it at that.
And I'm trying to find a very soft, polite way of saying it, but we're also restricted on this list. You and I visit enough groups of investors, whether they're clubs or chapters or whatever they are that are putting portfolios together. You and I understand that there are many of the practitioners that follow what we're doing that are very disciplined and that have portfolios that just amaze me, that just go nuts, much better than some of the portfolios I've managed to construct. But there are many folks that treat this as a social activity, and they don't spend as much time maybe as they should. And all of those kind of portfolios are being counted up when we put lists like this together.
Mm-hmm. And the collective performance is pretty impressive when it comes
to it. Yeah.
All right. Well, here, just to kind of take Ben Carlson's point and drive it home, and perhaps Michael Burry's, this is taking a look at the growth of ETFs since the year 2000, and that money is flying in there. With the exception of that month or so back in this most recent turbulence 2 years ago, that money is flying in there, and it's tapering off again, which can be one of those moments. But what I'm looking at here, keep in mind that the stuff that's doing this, that money is flying at Microsoft and Apple and companies like that, just by design, whether they deserve it or not. And just for kicks, here's a side-by-side comparison of the S&P 500 top 25 positions next to the NASDAQ 100, top 25 positions there. And you can see if you actually built a portfolio of half SPY and half QQQ, you're talking about $20 out of every $200 going into it. Did I get that right? Got to move my thing here. Well, out of every $100 that would be put into that combination, 20 of it would be Apple. And you can see how quickly those numbers add up at the very top of that page. I mean, if you force me to choose from one or the other, I'm probably picking the one on the right today, just based on the names that are on that list. All right, so that's kind of what Ben Carlson's point is, that the money is going to fly into the companies up at the top. Does that give them artificial price support? Deserved price support? I don't know. I don't know the answer to that question. But it's there. Tesla's there. All right.
As is Costco.
Yeah. And boy, I did a nice pick on Costco last year, didn't I?
Yep.
All right. Well, here's now Louis Navellier doesn't fall into that category of 30 and 20-year-olds that you were talking about a few minutes ago.
No, he's not.
But I just love this one because I often have given presentations that are even not investing related about this notion of absolutes. When you say something in an absolute sense, you virtually guarantee that it's wrong. And the key word here is forever. That he could have said they might last a long time, and he could have been right with that, but he can't be right with forever. And that, by the way, check the date on it. That's from less than 2 years ago, people. So that one didn't age very well. And just a reminder, not to be too absolute in what you're thinking, especially when it comes to the humility of the stock market and stock selection. So with that, let's go ahead and talk about what seems to be happening right now. And the reason this kind of comes up is this hits really close to home. Here in Detroit, we live almost within the shadow of a couple fairly big mortgage companies. So mortgages and automobiles is kind of the two biggest industries in the Detroit area. And there's some stuff happening, stuff going on that is kind of concerning. And this is where I think in terms of, boy, the Fed sure had one job, and I'm not sure that they did it quite as well as they could have. We're actually seeing, I'm hearing personal firsthand reports of mortgage originations approaching zero right now. And the projection is that they're gonna basically end up down in here, multi-year lows here very soon. And some of the mortgage companies are actually hiring distressed lending experts. And this actually goes back to a conversation you may recall this, Ken, that we had 6 or 9 months ago about they were tapering off the mortgage brokers that they were hiring. And they actually have really picked up the pace on that. And they're hiring people that are basically into bankruptcy and foreclosure. It's just not a pretty picture. And I'm not sure it has to be that way. And that's where I kind of have an ache over the suddenness and the magnitude of these recent changes. We basically took a 12-year trend and turned it around in less than 12 weeks. I don't think it's a good idea. Any thoughts? Can you talk me down off the ledge?
I'm not as sanguine as you are, Mark. I'm not feeling it as much, but I don't have some of the contacts you have either. I still see people desiring housing. I still see people moving towards looking for housing and buying housing. We had a foreclosed house 2 doors down and across the street from us that sat vacant for about 8 months, and there are people moving into it as we speak. It's just a very middle class neighborhood, no fancy homes or anything, but the homes don't stay on the market very long at all. There's small turnover, but when a house goes for sale, it sells within 2 or 3 weeks. Now, granted, the prices for these homes in my neighborhood are well under 250,000, so they're relatively inexpensive compared to average house prices anywhere else in the country, probably. But at the same time, I'm not as pessimistic as you. But like I said, I don't talk to the same people you talk to.
Well, I do know that. Well, first of all, the supply of housing is still a problem, and it's still basically a buyer's market, or an opportunity, or I should say, a seller's market. If you've got a house to sell, it's actually still fairly easy to do. The amount of refi activity, though, has really come to a screech. Also, and that's included in here. It's not just original mortgages. I'm 99% sure this includes refi activity also. So anyhow,
Well, we're getting a question, Mark. What does all of this portend for the home builders? Stocks right now that are turning in stellar, record-breaking quarters for profitability and everything. And I would take us back to a story you used to tell about the SSG being broken, and the fact that if you don't look ahead with the SSG as well as look backward, the SSG can tell you two different things on the same night. And Ty was the one that asked the question. All I would say is that in times like this, it's especially important that you take into account what the windshield is showing you as far as analysts' recommendations as to where sales are going to move in the next 6 months and year, and maybe 2 years, maybe 3 years, and not just blindly project sales based on past performance. That's a short answer for a fairly sophisticated, fairly long question, right, Mark?
well, I would agree with that. In fact, you're intimately aware of our Pulte Homes example from years ago,
Yep.
where we pointed out the virtues of the windshield when it comes to a situation like this. I think longer term, I think the home builders are a great place to be, fantastic place to be. It does basically suggest that there could be some shorter term turbulence. I won't be taking my LGI homes off the table anytime soon.
Well, and as you said, Mark, whenever we have turbulence, we as investors love it because we like getting those great quality stocks at a great price.
Yeah, and I guess I should be careful to separate my anxiety from. There's an investing opportunity here, but I also have some of the anxiety that I have is over what happens to the average person out there struggling to drive to work, and the ripple effect of allowing the economy to get into the condition that it seems to be headed towards. I think they need to do better. So,
We're really kind of arguing within our own minds a lot of times too, though, Mark, because in a way, I think that by flooding the economy with new money, I think we set ourselves up for some of the problems that the Fed originally thought they could control fairly easily, and have come to find out that's going to be a little bit tougher to control. I'm talking about inflation and other things, but the money supply just has exploded in the last 2 years, and I don't know of many people that were upfront enough to say, I really shouldn't have gotten that stimulus. I know of people in my own social circle that got that stimulus and basically said to their social circle, and they said it out loud to anybody that would listen. They didn't say it loud enough to send it back, but they said it to anybody that would listen, that stimulus was not designed with any kind of thought behind it. It was just rushed through and doled out to anybody that put their hand out for it. So we have to start looking at the money supply as well as interest rates, and I think it's going to be a lot harder to dry up the money supply than it is going to be to raise interest rates.
Yeah, at the risk of being accused of being a Monday morning quarterback, they should have been tapping the brakes on that a long time ago. And I mean that sincerely, tapping the brakes, not slamming the brakes on. Yeah, I think one of the things that we'll be taking a look at here very, very soon is going to be a presentation, Ken, where we basically take our Crossing the Chasm presentation and we turn it upside down. Because when you look at some of the financial results that have come in on a number of, especially a lot of the consumer companies, it's incredible. You know, what must have happened with some of that money flowing through the economy. And it's, I guess.
And what's so terrible too, Mark, is that it's very difficult to sort some of these other problems out and to pinpoint what's going on with some of the consumer companies. I mean, we know there were serious labor shortages. We know there were serious money supply things. But when I walk into a restaurant and they tell me they're putting a surcharge on all their prices because of supply chain constraints, I still intellectually, I might say to myself, well, maybe that's justified, but I still can't help but ask myself, how much of that is real and how much of that am I being taken advantage of, to be able to, I don't know. It's a very complicated situation with all this pandemic stuff that entered into the situation and all this extra cash that was floating around. And it all seemed to come together at once. Some of the worst possible things that you could possibly ask to happen seemed to be cascading one after the other after the other.
Yeah, and I guess I would argue this is potentially just a symptom of that turbulence. It's almost a festering situation. So we'll just go ahead and leave it at that for now. Again, my argument is for the government to do less. Don't misunderstand me. But do less and do it more timely and just be more logical about it. That's the engineer screaming at me. All right. For tonight, let's go ahead and close down here. We've got a few minutes. I did do a couple of screens. Here's the current Ivory soap screen. Again, that's a screen that's based on basically the combination of quality and the return forecast known as PAR. And we're basically searching for the top 0.5% of all companies. And I do believe, as Kim has reminded us, that in times like this, opportunity does manifest. And yeah, there's some home builders on there, Ken.
There's a lot of stocks that I own on this list, Mark. So, yeah.
Could be an opportunity to accumulate. I'm kind of intrigued by Trex. Long term. So good stuff. All right, and let me see if I put another one in here. Yeah, in a market turbulence with everything heading south, and the last I checked, the Nasdaq was down another couple percent before we came on. You're going to get some relative strength indices that push into the teens, and certainly below 30. And sometimes those are some awfully good companies. This is a list of companies that have fairly decent quality rankings that happen to be below 30 for a relative strength. So again, it can be a place to go shopping. I continue to be compelled by these guys, PayPal, and I need to understand this one better. This is one that we looked at briefly for the best small companies, but there are some companies in here that are just getting hammered. And again, it can be quite a rewarding situation to figure out if they're being unduly abused, stock price wise. Anything jump off the page here, Ken?
Well, 3 or 4 do, but not enough that right now I would nibble at very many on this particular list.
You probably like the previous page a little bit better.
I do,
Yeah.
yes.
Yeah, some of those at the top there are pretty solid. All right. Any other comments on that? I know you're not a technical analysis fan.
I I watch RSI. I just am not as big a fan of it because I've watched RSI stay above that line, and that little gray shaded area get pretty wide sometimes, and it's not precise enough for me to say that's a buy, that's a sell. It's just it's an indicator that might help make a final decision, but it's not something I start with.
Yeah, I agree. All right. Well, here's our moment for the chimp. He's moved back to number 9. A lot of very familiar names up at the top. I see Herb Lemkool's moved up into the top 4 with his Sin Soap and Soup. Sean continues to be up there fairly high. Again, in the middle of that pack, a lot of clubs arm wrestling for the number 1 slot there, including some former champions. Some good, clean fun, a lot of familiar names. We're almost on here. I went down to 42 to get Cy on the list.
I thought that I ran this list. Oh, I ran the list for last night, and you had moved up quite a bit, but you moved back down again, maybe on today's update. Okay.
Yeah, the NASDAQ is killing me.
Okay.
Oh,
I
don't
had-
worry. We're in
I
the
had
same
moved up to 51, so I was at one point I was down at 87. So I'm very happy to be back at 51 and moving in the right direction again. So maybe I'll in a couple of weeks, 5 weeks, I'll break the list at the top again here.
Well, we've had so many good years for the Groundhog participants. I guess this is just a reminder that the market really can be a great humiliator. Buffett, or his mentor, is who came up with that, I believe, originally. Benjamin Graham, I think, came up with the great humiliator, or at least somebody in that circle. And it does hand out humiliation from time to time.
Mark, am I missing the Wilshire 5000 on this top 42, or am I just not seeing it?
I set it aside and made sure that we were comparing that relative return column to the Wilshire.
I got it.
So
Okay.
19 people, actually 20, that are equally or beating the market. That is so historically low. We usually run in the 60 to 70% range for that. It's just
It's early.
the humiliator. Yeah, K-Light reminding us it's early. But Kathy did manage to sneak all the way down to the 165th now, so kind of been fascinating watching her struggle. And then Ken, we've agreed not to talk too much about this because we're seeing
Good. Let's keep moving then. Okay.
The audience did want me to leave the waving rabbit in there for you.
Okay. Hi, guy.
But I mean, we are into a full-blown bear market for the Russell 2000 growth, so thankfully we're staying ahead of that, and we can begin our march on the green bar. Here's just a quick snapshot of a fairly recent dashboard for the companies. You can see that the return forecasts are all in pretty decent shape. Okay, and just a reminder of a couple books that are in the till, and we'll be formalizing when we'll be taking a look at these in future months, weeks, I should say. And I have spent a little bit more time with this one. There's some nuggets in there. I'm not sure I'm going to make it through the whole thing because I've got this one too, and I really like Nick Majuli, and this one could be interesting. All right, here's a quick reminder that we do archive all of these sessions, including the round tables and other educational sessions, including our successful investing webcasts and conferences. Just go to
Mark, I got a couple people asking while you're talking. Could you go back one slide so they can copy Majuli's name? They're not knowing how to spell it. Okay, there we go.
Yeah, he actually works with Josh Brown at Ritholtz, and really bright statistician. It's Maggiulli that you see right there. And I do have that, and we'll be taking a closer look at it. And as I pointed out last week, I'm a fan of Jim O'Shaughnessy, and when somebody like Jim says something like that, I'm also a big time fan of Morgan as a writer. So good stuff. All right. I did also want to point out that Sean Mace has been putting some fairly intriguing, not just company shorts, but topical shorts. And you can see that there's been a fair amount of activity in this realm of thinking retirement. And it always warms my heart to see somebody that's among that younger crowd that you were talking about earlier, Ken, think seriously about retirement and enabling better retirements. So good stuff. All right. Just a reminder that we are getting together tonight for the April roundtable. We'll precede that session with a few moments with medium-sized companies, workhorses. And you're all welcome back at that. Again, 7:30 Eastern time for the workhorse presentation. And we will have that recorded and put on YouTube. And then, Ken, I don't know if you're aware of it, but 44 years ago this weekend, the Blues Brothers made their first appearance.
I actually watched this particular show, Mark, and I remember thinking to myself, are they trying to be funny or are they trying to be serious?
Well, it was an interesting time back in that time frame. A few years after that, we actually moved in to the neighborhood where the Belushis grew up in Wheaton, Illinois. So we met their mother. I'm not sure how she survived, but the Belushis actually attended the high school that our daughter would have gone to had we not moved to Michigan. So we knew a little bit of the Belushis back in Illinois. And
well, these gentlemen were known as comedians, but they had some chops as musicians as well, Mark. No doubt about it.
There is no doubt that they had it. They had it nailed. So good stuff. So 44 years ago, and rest in peace, John.
Yeah, I was only 4 years old when I watched that program, Mark. So
something like that.
Yeah.
All right. So with that, I think I'll go ahead and shut down the cast and see if we've got any questions. But we are back tonight, so we'll keep it fairly short. So everybody, don't be discouraged by what I'm saying. I'm worried more socially on a wider impact than investing, but it does have investing ramifications. In many cases, it becomes opportunities. But good luck out there, everybody, and thanks for being here.